if you look at the world today, you've seen the European markets, the debt issues creeping up in Europe. We have seen in North America as well, North America going again through debt issues. So it seems that the world stage is a bit volatile at the moment. There's a lot of uncertainty coming out of the global environment. But if you look at the local market as well, the local markets over the last 1 year have also been showing some significant decline. If you look at the equity markets in Kenya, the market is down about 17% year to date. So a foreign investor who put in 100 shillings at the beginning of the year has lost about 17%. And if you include the depreciation of the currency, the loss is actually probably closer to over 30%. So what is causing this currency to depreciate to the current levels? Many of us here have not seen the currency, the Kenyan shilling, operating where it is today. At the beginning of the year, we're at about 80 shillings to the dollar. As of yesterday, we're doing slightly over 95 shillings to the dollar. And the question is, what is happening? So what the team will do today, Mr. Anthony Muthiga and Mr. Ken Kaniu will walk us through the historical. Will walk us through the historical performance. So Kenneth will take us through the historical performance of the Kenya shilling. So we'll see how the shilling has performed over time. We are also going to look at the sources of strength of the Kenya shilling. What causes our shilling to strengthen, or what helps to support our Kenya shilling? I will also look at the source of weakness, and the sources of weakness are mainly import-driven. Either imports or other factors that cause our shilling to weaken. So we'll also go through that, and then Mr. Anthony Muthiga will walk us through the implications of a weak shilling. What does that imply to our different sectors? What does that imply to our tourism sector? What does it mean to our agricultural sector and all that? And then finally, we'll give you a Kenya shilling outlook of what we think it's going to be. So this is quite an interesting session. Sit tight. I think this is where we all become students. We'll take questions after this. So please just scribble down any question that you may have, and we'll take the questions after the session. So without further ado, I'll introduce Ken to walk us through the next step. Thank you.
Ladies and gentlemen, good morning. This forum, as has been mentioned, we will walk you through what, in our view, as the fund manager, has been going on with the currency. We may not be able to give you a definitive answer or put a pin through the ground to tell you exactly what is wrong with the currency, but we'll definitely leave this room more educated than when we came in. Just in terms of an agenda, this is what we have covered. This is my name. And basically, I'll just begin by walking you through historically what has been going on with the currency. Now, if you look at this particular graph, the bottom here is basically years in terms of time. So we've showed the evolution of the currency over the last 10 years. And on this scale here, you actually have the value of the Kenya shilling versus the dollar. And you can see between 2000 and 2002, 2003, not too much was happening here. This was before the onset of the current regime, the NARC regime. And we saw that basically after that, if you look at what was happening between 2003 and more or less the beginning of 2008, we steadily saw the currency appreciate during that period. And the currency went from around, let's say 74, 75 shillings, going all the way to 62. And that was basically because of the sort of policies that were put in place by the government. There was a lot of confidence in the workings of the government. From the point of view of economic growth, we saw some of the strongest economic growth that we saw during this period as well. Even in 2007, which was an election year, we saw that between June and December of 2007, the currency appreciated by 4%. So really that just spoke to the confidence that people had within the economy at that particular time. Obviously, after December 2007, we saw the onset of the post-election violence, and we subsequently saw the currency move from about 62 going all the way to 70 shillings, which is fine, and we expected that, obviously, because of the violence. But what we did see is that immediately after the violence, the currency went from the 70 shillings levels all the way back down to 62. And we saw that happen around April of 2008. So really, we saw that post-election violence scare, in as much as the currency spiked, the spike did not actually last very long. And by April 2008, the feeling within the economy was that really we had gotten way past that, and really we could get back to the focus on economic growth. But for those of us who may know, obviously 2008 was a very difficult year, because around August and September is when we saw the full impact of the global financial crisis. And this is really what we can call the first dislocation in the currency, because come September, the currency went all the way from, and that's September 2008, currency went all the way from 62 all the way up to 80. And that was the first dislocation, and we basically stayed at that level for the next 2 years, really oscillating between 75 and 80 shillings. So that was the first dislocation. And I think the second dislocation that we've seen here obviously has seen the currency move from 80 all the way up, I think, to the 95 shilling level that James mentioned earlier. And that is the second dislocation, and that is what is really causing a lot of concern currently in the economy. And it's really this particular spike here that we want to attempt to explain. I think if you look at the actual movement in terms of shillings, the difference between 62 and 80 is quite a lot. It's 18 shillings. But that was not really a concern because we are used to 80. We've been at 80 before. But I think the real issue here is moving from 80 to 95. We've never been at 90 before. We've never been at 95. So every year we've been setting, or rather every day we've been setting new highs. So that's really what is going to be the thrust of our presentation today. This graph here basically shows the performance of the Kenya shilling against obviously the Tanzanian currency, the Ugandan currency, and the South African rand. And all of this is based in shillings. So you have the performance of the Tanzanian shilling against the dollar, the performance of the Ugandan shilling against the dollar, and the performance of the South African rand against the dollar. And what you can see clearly here is that all the three East African currencies, Kenya, Tanzania, and Uganda, have all depreciated against the dollar over the last 1.5 years. You can also see here that over the last 1.5 years, the performance of the rand, it's actually fared fairly well because it has been strengthening against the dollar during that particular period. So the three East African currencies have been depreciating, and the South African rand has actually been appreciating. And I really think that if you look further and you try and unpackage the structure of these four currencies, you'll basically see that these three currencies here, Kenya, Uganda, Tanzania, these are all oil importing countries. We don't have any metals that we actually import or rather export. And if you look at South Africa, this is basically a country that, in as much as it imports oil, it also exports a lot of soft commodities. So this is more or less a commodity-backed currency, and this is more or less what we can call a currency which is not backed by any commodities. It's also fairly instructive to note that if you look at the performance of the Tanzanian shilling and the Ugandan shilling, they've actually fared worse over time than the Kenyan shilling. So we're not really, relative to our neighbors, in a very bad kind of situation. It's just that from an absolute perspective, obviously when one looks at 95, obviously the antennas tend to move up. Now traditionally, if you look at the Kenyan economy, these have tended to be the sources of strength for the Kenyan shilling. Obviously these are agricultural earnings, the inflows that we have historically from tea and coffee and so on. We have the remittances from the diaspora, so Kenyans living abroad who are sending money back, and the flows of those have been increasing steadily over time. We have this forex reserves which the central bank has been building over time. Obviously the purpose of the forex reserves is to stabilize a country's currency. We have things like portfolio inflows, so these are basically investment flows that come into the country, specifically target at things like equity and bond markets. We have here things like grants, we have things here like FDI, which obviously as they come in, and they come in dollars, they need to find shillings, so this tends to increase the value of the shilling. And we also have as well the tourism earnings, obviously from the tourists who come in year on year. So these six sources of strength, or these six inflows have tended to be responsible for the strength of the Kenya shilling. And what I want to do at this particular point is just walk us through all these 6 points, because I think the theory would say that if the Kenya shilling is weak, then it would basically mean that one of these factors is not working, is not really working. And you can see that steadily over time, the earnings from tea and coffee and horticulture as well have been steadily increasing. And I think we can see here that all the way from around, especially 2004, when really coffee and tea earnings and horticulture began to increase, as the earnings increased, we subsequently saw an appreciation in the value of the currency. And so you can see here that there's a fairly strong correlation. Obviously, as we get more money from tea and coffee, as we get more money from horticulture, the value of the shilling actually increases. And this is because as you get more of those dollars from the exports, they need to be converted into shillings. So you need to actually look for those shillings. So it increases the value of the shilling. So that correlation basically held right up until 2007. You can see that after 2007, our exports continue to increase from an agricultural perspective, but the currency actually goes upside down. It actually now begins to lose value rather than actually increase in value. So you can actually see that the correlation holds until 2007, but after 2007, agricultural earnings do not explain what has been happening to the value of the shilling. They don't explain the depreciation in the value of the currency. So really there's nothing wrong with agricultural earnings over the last 5 or 6 years. They've actually been working fairly well. So agricultural earnings do not explain the current value of the shilling. If you look at tourism earnings as well they've been doing fairly well. And you can see that all the way from, again, around 2004, right up until 2007, we saw a very steep increase in the value of our tourism earnings, and as well we saw a corresponding increase in the value of the shilling. It went all the way from around 80 all the way to around 65, 66 as of 2007. So a very nice correlation there. So as more tourists come, value of the shilling increases. But we saw now that after 2007, that dislocation was basically broken. We saw that in 2008, the money that we got from tourists went down, obviously as a result of the crisis, and it was actually in order for the currency to depreciate during that particular period. But after 2009 and even into 2010, as more tourists have come in, the value of the shilling has continued to decrease. We've continued to see a depreciation. So again, you can see here that tourism earnings are coming through, but again, they don't explain what has been happening to the value of the shilling. It's been decreasing. If you look again at diaspora remittances have been growing. They've been growing fairly nicely over time. You can see here that if you look again at the period between 2006 and even again 2007, 2008, as remittances increased, the value of the shilling actually went down, which was good, or rather went up. It went all the way from 80 to about 65, which is good. But again, we can see that the pattern is repeated. After 2007, in as much as the diaspora remittances continue to increase, but at a decreasing rate, the value of the shilling subsequently goes down. We actually begin to lose value. So again here we can see that it's not because diaspora remittances have gone down, they've actually gone up. They don't explain what has been happening to the value of the shilling. Again, if you look at our foreign exchange reserves have been increasing very nicely here. You can see that again in 2004 right up until 2007, as our reserves went up, the value of the shilling increased, or rather the shilling appreciated or strengthened in value, which is very good. But again, now we saw that after 2007, again, this correlation is completely broken here, so to speak. This particular graph is a bit different from the others because if you look over the last 3 years, the central bank has been coming into the market to try and boost its foreign reserves. And the only way to boost your foreign reserves is to come in with shillings, buy dollars, and basically go back and keep them in the safe. And that activity, increasing the supply of shillings, has really been also partly responsible for decreasing the value of the shilling, or making the shilling actually depreciate. So this is one of the slides that actually begins to come close to explaining currently what is going on with the currency. In terms of the equity market, what we have done here is that we have tracked the turnover that we see from foreign investors. So basically this is only buys and sells from foreign investors, and we've tracked this against the value of the shilling over the last 2 years. And basically we can see that the foreign activity that we've seen from the equity market is not fully responsible for the drop that we've seen in the value of the shilling. In fact, if anything, the value of foreign investment over the last 2 years has been increasing. The turnover has been increasing. But we've seen, obviously, completely upside down once again, the value of the shilling has continued to decrease. So again, equity market activity is not responsible, or these flows are not responsible currently for what is going on with the currency. Again, if you look at IMF disbursements, the kind of money that comes into the economy from the IMF, you can see here that between, especially 1995, basically going all the way to 2000, we didn't have a lot of money coming in from the IMF, obviously because of the policy stance that was taken by the government prior to 2002. But we've basically seen that between 2003 and going forward, the frequency of the IMF disbursements has been fairly robust, and again from a value perspective they have tended to go up as well. And you'd obviously expect that as money comes in from the IMF in dollars and looks to find shillings, the value of the shilling should increase, the shilling should appreciate. But actually we can see here from this graph, actually that has not been the case. In fact, the more money we've gotten from IMF, the worse the value of the shilling. So again, the IMF disbursements have been working, they've been coming in on stream, but this does not fully explain what is currently going on with the currency. So I think what we really wanted to show here is that if you look at all these factors, if you look at all these sources of strength of the Kenyan shilling, the sources of strength are actually working fine. From the point of view of the economy is actually working fine. From the point of view of agricultural earnings, diaspora remittances, forex reserves, portfolio inflows, grants, tourism earnings, these are coming in as actually planned. So they're coming in on schedule. So none of these are actually responsible for a drop in the value of the shilling. And it's not because we've had a drop in agricultural earnings or tourism earnings and so on and so forth. The currency is currently at its current phase. The value of the currency is actually explained by different factors, which we'll want to get into later on. So that basically explains the sources of strength for the Kenya shilling. What we want to do now is look at the sources of weakness for the Kenya shilling, because it works like a seesaw. Those strengths are supposed to strengthen the currency, and you also have the weaknesses which also come in and weaken the currency. So we want to see, if you put it on a seesaw, which one actually has more weight. And what we want to look at this morning are four factors. We want to look at our rising import bill, obviously as a result of the fiscal policy stance of the government. We're going to look at inflationary pressure. Has that contributed at all to the Kenya shilling weakness? We're going to look at market expectations. What is the market expecting and our expectations being met? Is there a gap between expectations and the current reality that we have now? And we're also going to look at global dynamics, because those do have a role to play when it comes to explaining the current weak stance of our value of the Kenya shilling. We've basically seen our imports increase, and specifically our oil import bill has really gone up. Oil now constitutes around 25% of all our imports, so it's a fairly significant number. And you can see basically here that as the oil import bill has increased, and this is the yellow line here, and this is really millions of dollars. As the oil import bill has increased, the shilling has also begun to decrease in value. I think it's instructive to note here that if you look at this particular point in 2008, well, our oil import bill was at its lowest, which means that we were importing quite, as little oil, or very little oil over this particular period. We also saw that the shilling had actually strengthened to one of its strongest particular points here. So the correlation was fairly good. But as we subsequently saw the value of our oil imports go up, we also saw the value of the shilling now begin to collapse.
Both air and railway transport is affected by extension. And by communication, it affects the entire telecom sector, especially where they are in a period of importing heavy equipment, and especially when those equipment don't carry a tax incentives, like in some of the cases. The property sector, this again carries a double-edged sword from currency perspective, largely benefits, but sometimes impacted. Having a weaker shilling for a foreign investor in the property sector in Kenya, the assets in the country are perceived to be, and are actually, more affordable or cheaper. So there's a likelihood to see increased diaspora investments in the property side, just taking advantage of carrying a strong shilling, a strong foreign currency like the dollar, and buying an asset in shillings, which is an environment of a weaker currency. So diaspora investments, mainly to the property sector, are likely to increase or have been increasing. But on the contrary, in a booming property market where most of the inputs in buildings are imported, apart from land, cost of steel specifically and paint contributes a bigger portion of property projects, and by extension impacts negatively to the sector. And that feeds through the prices of those assets, of those properties, and the unit costs again tend to be higher. On the capital market, where as Stanbic Investments we spend most of our time, this is both the equities and the bond market. A weaker shilling is by and large impact negative on this space. And by extension, you see what you call equity valuations due to inflation coming under pressure, partly explains why there's been a run down on prices at the Nairobi Stock Exchange. There's reduced portfolio inflows by foreign investors, mainly because of the uncertainty on the currency, and more importantly, knowing that you bring in, for example, $1 million to buy securities at the Nairobi Stock Exchange, and within a week, your value from a dollar perspective has weakened, as explained by James, where you've gotten a hit on the prices by 15%, then you get another hit by over 10% on the currency. So if you want to repatriate back your money, you're getting a hit from the currency because you're exchanging a strong currency for a weak currency. So that has a negative effect to the capital markets. There's a shift of funds to money market investments, which are basically short-term investments. And that again is a signal of what Ken tried to explain, a flight to safety, where due to that uncertainty, investors will want to invest short-term by not being sure of the direction of the shilling in the short term. And there's a wait-and-see attitude on that. Lastly, a weak shilling, as shown here, sometimes is addressed by a tightening monetary policy where interest rates tend to go up to address rising inflation. And by extension, that brings in pressure to a market like the bond market, where values fall down, the wealth of investors in the bond market comes down, and that is implied that a weak shilling on a bond market, which leads to high inflation and by extension rising interest rates, is not good for capital markets. Lastly, we'll want to share with you a few responses of the Central Bank of Kenya on environment on a weak shilling. First of all, as I've mentioned, one of the responses has been monetary tightening. This is principally allowing interest rates to go up gradually, being able to take expensive money from investors, and this is replicated simply by a single rate by the 90, for example, the 91 T-bill rate. Over the last few weeks actually, risen from a low of 3% to currently around a high of 9%. So that has been one of the responses. Secondly, the regulator of banks has tried to admit more players to the foreign exchange market, just to induce more participation, more competition to commercial banks who have remained the key players on the forex market. And this admission is more of people like forex bureaus. Thirdly, the central bank has actually intervened directly on trying to address a weak shilling. This has been by trying to either pump in more dollars to buy shillings or sometimes sell shillings to buy dollars interchangingly. And these activities are very common as often as yesterday. And they have been happening throughout the time when the shilling has been falling from a strength of 85 to the current 95 to the US dollar. Lastly, the central bank, using its influence, has pursued both moral persuasion and some disciplinary activities to curb speculative tendencies by some of the FX or foreign exchange players. And that again has been a response to the weakening of the shilling. On an outlook, from where we sit as Stanbic Investments, the Kenyan shilling, the direction of the shilling to us still remains uncertain. There is an indication the weakening continues, but the direction in totality, looking at the factors which strengthen it, looking at the factors which weaken it, remains uncertain. Because the factors which strengthen the shilling are performing well. The natural inflows highlighted by our colleague Ken are actually flowing in, they're performing strongly. So the direction remains uncertain. But there's a bias to weakness, mainly by those factors shown there, 5 of them. The current inflationary expectations portend for a weak shilling, implying that rising inflation, which tends to lead to rising rates to compensate investors for loss of value, also portends for a weak shilling. Government fiscal policy, these activities of government, either in borrowing and expenditure, also portend for a weak shilling. The rising import bill, mainly fueled by two main items, that's oil and food, still portends for a weaker shilling. Political uncertainty, but specifically on the looming elections next year, again, tends to raise the sovereign risk of the country and by extension weakens the currency. And of course the ongoing global uncertainty, which now for the first time in history is being led by the US. That again tends to give us a notion that the outlook of the shilling, though uncertain at the moment, in the short term remains towards the weakening bias.
We don't want to speculate on the key measures that CBK wants to take at this moment. I think your guess is as good as mine on that. But we've just highlighted that market expectations are that the only way probably to arrest the situation is probably to increase interest rates. But now looking at that is also a double-edged sword, because we are looking at a situation whereby we want economic growth at the same time we want to arrest the situation. So if they are to increase the rates, which we are expecting, I mean, anyone in the financial markets will expect that, we'll see a situation whereby it will affect negatively on the economy, and by and large actually fuel inflation down the line. So it's more of a short-term measure, which they have highlighted is not very sustainable. So from that signaling effect, we think that they might not increase, but your guess is as good as mine on that one.
The CBR rate, which has been the most adjusted rate over the last, I would say, 18 months, since its inception, it has never, by and large, been a very effective rule of giving direction on interest rates. And my colleague mentioned to you that its purpose is used by banks to borrow from the central bank as a last resort. Banks, by the structure of our industry, have the ability to have alternative sources of meeting their overnight liquidity or payment obligations without necessarily going to the central bank. So by them not using that rate for a long time, that rate has not been effective in addressing any monetary policy related issues. But of late, over the last, I would say, 6 months, its up and down adjustment has become, as Abdis told you, a signal to direction of interest rates. And we've also put it clear here: if interest rates edge upwards or are made to be allowed to edge upwards slightly, that might correct the weakening shilling by one simple fact: addressing inflation, compensating investors for a high cost of living. So whether those policies by the central bank are working, it's not the right time to say if they're working or not, because the CBR has been adjusted often over the last 4 meetings of the Monetary Policy Committee. So it's a very short period to judge the effectiveness of a rate like the CBR to handle a weakening shilling. But what it has done, it has shown a signaling effect on direction of interest rates. The adjustments up and down are also put in the full perspective of what? Of the economy, as highlighted again here. You want to spur growth, economic growth, and by extension, you need availability of cheap, affordable credit. So that's the double-edged sword. You don't want to make credit expensive by rising rates to address a weakening shilling, and vice versa. You don't want to let a weakening shilling discourage foreign investment. So that's the balance, I guess, the banking sector regulator is trying to address. I think with time, especially with the fullness of 2011, we'll be able to tell whether the monetary policies put in place can fully explain the weakening or the addressing the weakening of the shilling, especially to the end of the year.
I think a lot of questions are being asked, is somebody burying their heads in the sand? And really for us as Stanbic Investments, as a fund manager, we may not even know where this sand is. We also may not know how deep this sand actually goes. So really it's not our area to come in and actually try and indict somebody and say they're doing X, Y, Z. What we can, however, do is comment on the sort of policies that the guys are putting in place. And I think, as Anthony has clearly mentioned, it's simply an issue of prioritization. For them, obviously, the priority appears to be on things like liquidity. It appears to be on things like economic growth. And really, from the point of view of the currency, I think the message from the guys is that it's going to sort itself out. As a market, maybe that is not what we want, but that seems to be the position that the guys are taking. Now, from the point of view of the balance of payments position, the question that is being asked is, is the deficit that we're currently running, a problem for the economy, and for how much longer can it continue running like that? But really, from the point of view of a deficit or even a trade surplus, both of them can be both good and bad. As you're running an economy, you don't also want to have a huge trade surplus, because when you have a huge trade surplus, it actually leads to the value of your currency strengthening, and it strengthens fairly significantly. You don't want also, as an economy, a very strong currency, because it tends to make the value of your goods fairly expensive, and you subsequently become fairly non-competitive. At the same time, there's also nothing wrong with a trade deficit, because it basically means that if you have a trade deficit, you're basically a country that's trying to develop and increase yourself through the value of imports. If you look at, obviously, the extreme case scenario where you have, for example, a country like the US, if you look at the global model is basically that the US sits at the center, and the US is basically the consumer of all goods and services from places like Europe, places like Asia. So if you talk of things like cars, you talk of pharmaceuticals, and so on and so forth, the US is the net consumer, and that is why they've got a very large trade deficit, and it's subsequently leading to the current problems that they have at the moment. I think for us, the level of the trade deficit as we have it now, from an absolute terms perspective, is not an issue. I mean, if you're importing $15 billion worth of goods every year, that is definitely not an issue. But the issue is relative to what? And relative to the exports levels that we have, and our export level is at about $5 billion, that is where you have a problem. When your imports are twice your exports, then you run a problem from the point of view of the currency. And I think what we want to do is that we need to increase the value of the exports that we have to actually begin to counterbalance the impact that we're seeing in the currency. Because we don't want to go and tell the guys at Treasury, can you please stop importing goods? Because if you stop importing goods, then really you are slowing down consumption, you're slowing down growth from the point of view of the economy. So there's really nothing wrong that we have currently from the point of view of the trade deficit. From the point of view of absolute terms, it's definitely not an issue. $15 billion is not a large number. But relative to the export position, that is where we do have a bit of a problem. So we need the value of our exports to begin to increase. We need to spur the manufacturing sector. We need companies in Kenya to either expand domestic consumption or increase the regional consumption of goods and services that we have.
Positive effect to a shilling does not come naturally, but the effect to a strong, a downgrade of a U.S. debt has more global shivers than to a specific economy. And as Steve says, it's mainly on investor sentiment. You all know, aware that over a third of the U.S. debt is held by one country, that's China. To them, that's a more concern, being a country which is holding U.S. debt, which has just been downgraded. Just to add on Ken's point about the negative balance of trade, he's rightly put it, it's not a bad thing to be carrying a net import position. Why? Provided we're importing goods or even services meant to spur economic activity and production. There are countries who don't export anything, and they will not export anything for a longer time. That's not a bad thing, provided what is being exported filters through to economic activity and production. Thank you.
I think what the CBK has been doing about all this, whether it's enough, whether it's adequate, whether it's not, and this and that. I think as has been mentioned, obviously what has been presented here today is more to discuss what is causing the shilling to depreciate. The central bank is doing whatever they can to stabilize the situation. Obviously, this is an unprecedented situation we find ourselves in, and the central bank is trying all its best. Now, we can debate whether it's right or wrong, or whether it's adequate or not. I think that's, we probably all have different positions of how to correct the situation. I think what's clear is that the economy is humming properly from an export side in terms of the revenue flows that are supposed to be coming in from agriculture, from tourism, from diaspora remittances, and all that. I think on the import side, we've actually seen what's causing the shilling to depreciate, which we've attributed strongly to imports. I think we can all attest to that, whether it's oil, whether it's food prices. So I think there was a comment that maybe what we need to be addressing is structural challenges within our country. But then what you're going through is not just unique to Kenya. Uganda and Tanzania are also going through the same thing. We've seen the Bank of Uganda coming to intervene by by using dollars in the market. It works 1 week, the following week it goes back to to depreciating. So the central bank, this is a time when you go back to your textbook and try to see how can we stabilize the situation. If you look at the US when they went through the recession, again, given the depth of that recession, they tried a couple of things to try to stabilize the situation. Some of them worked, some of them didn't work, but eventually you can see they're coming out of it. So I think what's important at this point is to look at what is actually causing this. What do we need to do to come out of it eventually? We can actually see that our import bill has been going up, so we need to grow our exports to be able to counter the impact of the impact of our strong imports. Maybe do we need to set up a strategic reserves for oil, maybe to caution against inflation, and maybe grow inflation gradually if we need to go there. Do we need to work on our food? Maybe become more sustain ourselves from an agricultural point of view, as opposed to being strong importers of food. So I think that's where, as a country, that's where we need to be. But if you look at our economies again, we are at a point where the economy is growing significantly. I think you can see Nairobi, as you said, is a construction site right now. The whole country is also going to expand quite significantly as you go to the counties. So what does that mean? That means that you still continue to have pressures on prices. You continue to see probably more employment. More employment means higher demand for goods and services, probably more consumption, and again it goes back to the issue talking about of imports. So when you talk about more imports, again we go into the same situation. So the central bank is caught up between, and I'm not speaking for them, but I would like to point out that they also caught between a rock and a hard place, because you want to spur the country to grow, but you also don't want to to limit that growth, and you also want to slow down inflation.
If you look at the CBR rate as shown by our presentation here, it's been naturally going down since its inception in mid-2006, but there are some times where it has been brought up and down, and the effect is not quantifiable. So it's very hard for us to make a call on how many bips or basis points can arrest a weakening shilling.
What we are basically interested in is the trend. What is that direction? Is it actually up or is it actually down? For those who've been tracking the financial markets and you saw what was happening around June and July, we saw the central bank rate move up from about 6.25% to about 8%. And it went up by 8% and stayed at that level for about 3 weeks. Now, during that particular period, because of the moving of the rate up to 8, we actually saw the value of the shilling strengthen. It strengthened to a small degree. It went actually below 80 shillings, which was very positive. But we subsequently saw that 3 weeks after that, the central bank issued yet another banking circular. I think it was banking circular number 6. They took the rate back down to 6.25, and again we saw the value of the shilling actually decrease value. So I think it was very clear at that particular point that if you actually take the CBR up, then the market will actually come in and actually, from a market expectations perspective, take the value of the shilling up. So in as much as one may not be able to quantify the number, from a trend perspective, I think it's very clear for everybody to see that if it does go up, it should have an impact on the value of the shilling.
Can forex bureaus address a weakening shilling? The regulations have just been introduced by the regulator to try and increase competition in bidding of of foreign currency by introducing forex bureaus. We can't at the moment tell the effects of the ability to offer that extra competition to billing for foreign currency, but the intention by the bank's regulator to do that is to improve the participation of more players on the forex side. Whether they are able to plunge an effect on the shilling, it's a matter of wait and see. Thirdly, are the CBK measures working to address a weakening shilling? As much as the central bank is not on the dock in this forum, what we've shown here is that the shilling has its natural sources of strength, which are working, or the inflows related to those strengths are coming in strongly. We've shown you the weaknesses, or the sources of weakness of the shilling, which more and more are impacted by factors mostly outside the control of this economy and regulation. And we think that it's a combination of factors which will address a falling shilling, but not the effectiveness of one entity or regulator at this particular time. The fourth question, I think it was still concerning the regulator. Again, have they buried their sand? And this is the regulator of banks, not the regulator of ourselves. Have they buried their head on the sand? Again, it's not our intention to make that call. We'll wait and see if the measures they are putting in place if they'll address the weakening shilling. Lastly, there's a very strong structural indication question relating to is the economy having structural weaknesses which are portending or fueling a weakening shilling? My call on this is yes, there are structural weaknesses of the economy which are yet to address a weakening shilling, and by extension, any time the fundamental sources of a solution, like strong inflows, are unable to address a currency weakening, by extension, there are structural gaps or challenges, and by extension, it's other measures which might have to come to play to address the scenario. But from an economic perspective, we wish to state that we strongly feel all the key sectors which are sources of forex exchange in this country are working. And on the flip side, what about a strong shilling? Or what might correct the bias to a weak shilling? We've elected one item, which is the import bill. The import bill is what is negating, by and large, the positive inflows. And the import bill is made up of two items, mainly oil, and to some extent, food-related items, which, to this stage, the food import bill is slightly coming down. We've seen indications of food commodities, specifically like maize, improving in pricing, and local production coming on board. So that tends to check an import bill. And secondly, the gloomy global economic outlook might lead to softening of the the price of oil due to some depressed demand. And that might lead to a correction on the oil price. By extension, again, lowering the oil import bill. So that, again, will strongly give support to the shilling, especially when there's a check on the import bill.